Well, good morning, ladies and gentlemen. Thank you again for joining us this morning's very special lecture on international financial system and financial crisis. We are very fortunate to have a special guest speaker this morning who is the authority in the fields. I'm not alone to say this. I will just quote Neil Ferguson, who is a very renowned historian who wrote so much about economic financial history himself. You know, he commented on her very famous book, which was bestseller, New York Times bestseller, titled "This Time is Different." Neil said, let me quote, "This is quite simply the best empirical investigation of financial crisis ever published, period." And then he went on to say that this single volume is worth 1,000 mathematical models. That's what Neil Ferguson said. We are very, very fortunate to have Professor Carmen Reinhart this morning. Actually, she happened to be in town to attend a meeting at the Bank of Korea, and she gave a keynote address yesterday. I'm sure some of you must have seen what she said yesterday through media. Well, since she was in town, we invited her, and she gladly accepted. We thank you very much for joining us this morning. And I don't think I'll waste any more time, and we'll have Chairman Chun proceed the meeting. Please join me again in thanking Professor Reinhart.
Thank you, Dr. Sagong. Good morning, ladies and gentlemen. Once again, welcome to IG Forum this morning. We are very fortunate to have truly outstanding speaker, Professor Carmen Reinhart, as our special guest at our forum this morning. As you know, IEG has a long tradition of inviting global leaders to its distinguished lecture series. But I think this time is different. I say this because we are so very excited about having Professor Reinhart, who is truly exceptional and influential scholar of our time. She will talk about a very timely issue of international financial architecture today. Before we invite Professor Reinhart to the podium, allow me to say a few words about her exceptional credentials. Professor Reinhart is currently chair professor of the International Financial System at Harvard Kennedy School. Previously, she was a senior fellow at the Peterson Institute for International Economics, chief economist at Bear Stearns, and senior policy advisor as well as deputy director at IMF. I had the pleasure overlapping my time at the bank with Carmen's days at the fund in Washington. As Dr. Sagong said just before, Professor Reinhart is perhaps best known for her bestseller book entitled "This Time is Different: 8 Centuries of Financial Folly," which greatly contributed to the understanding of financial crisis in both advanced economies and emerging markets. It has been translated to over 20 languages, Korean, of course, included, and won the prestigious Paul A. Samuelson Award. She received her PhD from Columbia University. Without further ado, let's welcome Professor Reinhart. She will speak for about 35-40 minutes, followed by 20 minutes Q&A. Thank you.
It's really a pleasure and an honor to be here, and I have hoped that my coverage of topics, which is on global risks, is appropriate to the current environment, the current concerns. So what I would like to do is basically do a global tour of what some of the major risks. I won't be covering all the potential risks, but I'll try to hit on the major topics, and especially those that have international spillovers. I'll divide or organize my thoughts into some of the risks that are emanating from the advanced economies, some of the risks that are emanating from emerging markets, obviously, and most importantly, including China. And then I will talk a little bit about some of the longer-term concerns I have about the financial architecture, which currency will be the anchor currency, the reserve currency. So that's my game plan this morning. And let me start by saying that I am not of the gloom and doom variety. My expectation up until very recently this year was not that, for example, the United States would be heading into a recession later in this year. My expectation, and I think it is soundly based on the available indicators, was to expect a slowdown. As you probably know, growth has been in the U.S. a little above 3%, so the expectation was for a slowdown to the slightly above 2% area, but not recession. Let me also say that in the last couple of weeks, all the shocks that we get from the White House have been adverse. So it is difficult not to highlight that whatever risks there are to the outlook are likely to be risks on the downside rather than the upside. I'm just providing a setting of what my baseline is. The other component of my baseline was, as you, especially those of you in the financial markets, the financial industry know, there is the expectation that the Federal Reserve would lower interest rates one more time in 2018. There's expectations that the Federal Reserve would reduce interest rates by 25 basis points. That also had not been my expectation. My expectation was basically that the Federal Reserve would be patient and that U.S. interest rates would remain unchanged. The basis, very briefly, for that expectation is that, as I shall discuss, the U.S. economy is at present at or very near full employment. The unemployment rate is the lowest it's been since the 1960s. So unless something really negative evolves, I think the Federal Reserve policy is likely to be one of patience. Now I've laid out hopefully what my baseline scenario is. Now I'm going to talk about the individual risks that I see. First of all, in the more immediate period, meaning 2020 and the nearer term, before I get to the long-term risks. So one common theme that I'm going to return to, and I'm going to return to this when I also speak of China in talking about emerging markets, is the issue of how much ammunition do governments and central banks in the advanced economies have if there is another downturn. And that's going to be my starting point. And let me start with fiscal policy. What I'm showing in this chart is government debt, public debt, from 1900 to the present, to the end of 2018, for 22 advanced economies. The black line is the United States. Let me offer 3 takeaways from this picture. Overall, the picture is one in which advanced economies have very high levels of debt, the highest levels of debt since the end of World War II. And this raises questions about how much fiscal space there is to deal with the downturn. At the end, when all is said and told, when the crisis of 2008-2009 unfolded, advanced economies were not in wonderful shape, but certainly they were in much better conditions to react strongly to a downturn than they are today. I would note that another takeaway of this picture is not what you see in the picture, is what you don't see, which is advanced economies at the end of World War II had a lot of public debt, but private debt was nothing. That's not the situation. It's not the situation here in Korea either. I mean, right, Korea is on the low end of the spectrum in public debt, but private debt is a contingent liability, ultimately, of the government, or so it happens in history again and again. In Ireland, in Spain, public debt before the global financial crisis was below 30% of GDP. But they had a lot of private debt in banks, in households, and that private debt became public debt after the crisis. So what you don't see in this picture is the fact that at the end of World War II, that peak was just, that tells you the whole story. But the current peak doesn't tell you the whole story, and hence my concern about limited fiscal space. Let me make one further comment just on the U.S. situation before I turn to monetary policy and what I think is also limited space on monetary policy. For years and years, it goes back not to Chairman Yellen, but to Chairman Bernanke, the global saving glut. Well, another term for the global saving glut was the U.S. kept running big current account deficits and financing those deficits by borrowing from the rest of the world. This has been going on more or less nonstop since the 80s. That's old news. So what is the news? The new news is that ultimately, if you keep having deficits on a chronic basis, your debt builds up. And what used to be and this is what I note at the top of this figure, what used to be a twin deficit problem is now also a stock problem. Now the U.S. does have higher levels of debt relative to many of its, to much of its cohort. Let me also say that the takeaway from this figure is one in the current debate in the U.S. is very eminent scholars like Olivier Blanchard say we do not worry about fiscal deficits, we do not worry about debt because interest rates are low. That's a big recurring theme. I'm very concerned about that because interest rates are low until they are not low. That is what usually happens when you look back. But even beyond that, I was in the advisory board of the Congressional Budget Office for many years. And the CBO, the Congressional Budget Office, is nonpartisan, and their study basically shows that in less than a decade, even with interest rates where they are, or even with interest rates 50 basis points below where they are, the U.S. begins to have a debt sustainability problem. So I'll leave that there on fiscal space. Turn to monetary policy. So, and again, remember, I'm here to talk about risk. This is not that the end of the world is coming. I'm just saying that one thing to be concerned about is that if we have a downturn, our toolbox is pretty depleted. The average decline in U.S. interest rates engineered by the Federal Reserve whenever there has been whenever they've been fighting a recession has been 600 basis points. That's the average, 6%. Currently, interest rates, long interest rates are roughly, let's just say roughly 2.5. So ammunition in the U.S. is not what normally, it doesn't offer the Fed the room to ease that it has had, or anything close to it that it's had in the past. Turn to Japan, turn to Europe, where interest rates are already negative, and the situation is further complicated. So that, let me switch gears. What I'm doing is listing a menu of risks. So I'm going to go on to the next item on the menu, which is in everyone's mind, trade. One notorious lesson from history was that the rise in protectionism in the early 1930s turned what was possibly a more normal recession into a depression. And this chart here is taken from my book with Ken Rogoff. That's why it ends in 2009. I'm going to show you the recent data. But it basically highlighted the very abnormal impact on global trade of the wave of protectionism of the 30s. Let's move forward to the current environment. And here we have global trade through the latest data. And let me make 3 points about this figure. Globalization, the first point is the idea that we're the first generation to have seen globalization is not correct. If you go back in history, trade and finance were very integrated in the late 19th century and up to World War I. That was a big era of financial and trade globalization, not to the same degree as today because we didn't have the technology that we have today, but it was a very integrated, globalized era. World War I, the Great Depression, and then World War II did away with globalization. So we went from high globalization to a period after World War II, Bretton Woods, with capital controls, with a lot more protectionism. And the question is, are we hitting another cycle? Let me make a second set of observations apart from the long cycles in globalization. My second observation is that the first blow to globalization was the global financial crisis. Average growth in world trade was 5.9% in the decade before the crisis. And since the crisis, that average was cut in less than half. Then, after that, we've had Brexit, and now we have President Trump. And so the concern is, without being melodramatic, one where we are focused on the tariff discussion, but my own sense is that this trade dispute is not going to end with just tariffs, but with a lot more non-tariff barriers. Some of those, I think, will affect Korea importantly. For example, if China, concerned about losing its current account surplus and moving into current account deficit, begins to curtail tourism more. I am also concerned that the trade negotiations, what started out mostly as trade negotiations, has spread out to more geopolitical issues and security issues that are not going to be resolved quickly. So the bottom line is, where I started out expecting more resolution to the trade debate and the trade disagreements, I'm not saying that there will need to be some agreements, because President Trump does face an election schedule, which, importantly, I think he will feel compelled to deliver something on that score prior to elections. But nonetheless, I think that the turn that the more geopolitical turn that things have taken may mean that we are never going back to that higher plateau, and that in all probability the next plateau will be lower. That's my even without the gloom and doom of the previous slide. I think the next plateau is a lower one in trade. Let me turn to Europe. I know that Europe is not the biggest source of concern, certainly in Asia. But let me say the following. We lived in a global economy. And when Italy in 2018 had a new government, and that new government began to make pronouncements about potential of leaving the euro or how it was going to deal with debt, it impacted currency markets significantly. The euro took a nosedive, the dollar appreciated, and when the dollar appreciated, I also follow very closely emerging markets. Those emerging markets that had dollar debts were hit really hard. And it's an issue I'm going to come back to. But let me say the following. The European situation is, and I think this chart highlights the point I'm trying to make. The European situation is not worrying necessarily about the next crisis, but the fact that the last crisis has not been resolved. In Greece and in Italy, and let me highlight Greece, Ireland, and Portugal, the three countries that had problems in the Eurozone are less than 7% of Eurozone GDP. But Italy is more than 15% of Eurozone GDP and has more than 25% of the debt of Eurozone. Point being made here is Greece and Italy have per capita income levels that are below what they were in 2007. Furthermore, if you go to the IMF World Economic Outlook, and they do projections to 2024, neither Greece nor Italy will be at the per capita level of income in 2024 that they had in 2007. So in Korea, we all remember, I certainly do, the crisis of 1997. But contrast the upper line, the recovery path from, it was a deep crisis, it shook the economy, but the recovery was very decisive. It may not feel decisive, but it was. But you look at the contrast of the Italian and Greek experience, and you see why I say this is a chronic cloud over European growth, and it's a major constraining factor in European politics and European policymaking, which is why the ECB, notwithstanding who replaces Governor Draghi, is in a mode in which low interest rates look far out into the horizon. Let me turn to another type of risk. This is the last of my risks on the advanced economies before I talk about China and emerging markets. One common element of this discussion is between the risks that I am describing here is that this risk also is well understood by the Federal Reserve. It's evident. They've written about this in their financial stability report. So what the solid line shows, the blue line, is the U.S. federal funds rate, in which you see since the end of 2015, the Fed supposedly began to tighten. However, what you see in the green line are measures of financial conditions, which basically says, except for a brief period in 2018, financial conditions have remained very accommodative. What this meant is that in a low interest rate, high liquidity environment, risk-taking has increased. And what I'm going to do is make a comparison between the mortgage-backed security bubble before the crisis of 2008, 2009, and what's going on in the U.S. corporate market now. What this chart shows, the red line, is the ratio of the yield on low-grade, high-yield corporates to U.S. Treasuries. What the green line shows is the emerging market sovereign yields relative to U.S. Treasuries. Typically, those two high-yield, high-risk assets move together. What has happened is that corporate bonds have become very bubbly. There's great demand, and let me outline the similarities and difference between the subprime, before the subprime, and the corporates. What are the similarities? Number one, the quality of borrowers has diminished. In the early mortgage-backed securities era, the first mortgages, the subprime mortgages, were actually pretty good quality. Then quality started to diminish. The borrowers were riskier. Same thing has happened here. Great appetite, driving up the prices of this debt, driving down the yields. That was common in 2008, and it is common now. Looser supervision of standards, underwriting standards was an issue then, it is an issue now. What is the biggest difference? Thankfully, that this market is not nearly as big in terms of the impact on the U.S. economy as in the mortgage-backed area, which affected households, a much bigger chunk of the U.S. economy. Let me make one final point that is similar, very similar to 2008, 2009. Buying of these high-yield corporates is not just a U.S. phenomenon. One of the largest buyers have been Japanese banks. And this is also going on in Europe. So remember, a lot of the global spillovers of the subprime crisis to German banks and French banks was because those banks had bought U.S. subprime paper. That international transmission is going on today also. Okay, now, again, continuing in my menu, I am going to turn to global risks in emerging market, and I'm going to start with, I think, the area that is the biggest from the footprint it has on the global economy, the global risk associated with China. And I would like to start focusing, really go back to the very first thing that I mentioned. My first topic, or first source of risk, if you recall, was that the advanced economies didn't have that much ammunition to stimulate the economy, either on the fiscal side or on the monetary side. I'm going to argue that while China still has scope and it is implemented an aggressive fiscal stimulus, I think the scope to stimulate on the monetary policy side is not there. And let me labor, because at the end of the day, in 2008, 2009, China's fiscal stimulus was unprecedented in scale. But so was the stimulus coming from credit creation. A lot of directed credit, a big monetary stimulus. It is in no condition to do that now. And let me highlight this on the basis of the capital flow cycle. In 2008, 2009, China had been growing at double digits, and it was the magnet for global capital inflows on a grand scale as seen through the accumulation of reserves. What I am plotting here is international reserves, Chinese international reserves, converted to renminbi, divided by M2, the broader monetary aggregate. This goes back to my work with Graciela Kaminsky more than 20 years ago. It's a really good indicator of the capital flow cycle. And what we're seeing is that basically reserves to M2 have gone back to the levels of the early 2000s. So what does this imply for monetary policy? Well, we understand, and I think everyone in this room is aware that China has also an important high debt, high leverage problem, especially corporate debt. But also part of the corporate problem in China is not just the leverage, but also it's a hit to competitiveness. It has been overvalued. In other words, since 2015, when EM currencies and other currencies have depreciated, the RMB has not depreciated at par. But you would say, if left to their own devices, perhaps the POBC would love some greater degree of depreciation. But let me caution saying that I don't think that that's really in the cards for two reasons. One is external, which is the rocky relationship with the U.S. And so a very sharp depreciation of the renminbi, I think, would be yet another source of friction in these negotiations. Secondly, even forgetting about the negotiations, every time the renminbi has had a significant depreciation, and significant quote unquote, because they're modest depreciations by international comparisons. But every time that the renminbi has had a depreciation, it's been associated with capital flight and reserve losses. So what does a central bank that is trying to limit a depreciation do? Well, they can do one of three things. They can tighten capital controls, very probable. They already did that in 2015, the end of 2015. I was at the G20 meetings when all the announcements of the new measures went into effect. They can tighten capital controls. They can lose reserves. They've been doing that. The latest tick data, the tick is the Treasury, U.S. Treasury record of who owns securities, show a very significant decline in China's Treasury holdings in the last month. So they can tighten controls, they can lose reserves, or they can tighten policy. And my bet is that it will be a combination of this, but the tightening policy part is integral. So some of the same statements about China not having as much ammunition to stimulate also hold here for a different set of reasons, but they hold. And I would say that the single biggest unknown at the moment is whether the actual GDP numbers showing growth somewhere in the 6% vicinity are indeed real. There's a big concern that the slowdown that has taken place may be more pronounced. Certainly, if you look at the slowdown in trading partners, it's been more pronounced. If you look at commodity markets, they're not tanking, but it's not consistent with that strong an expansion. So I think I cannot emphasize enough the importance of this for the global economy, because China's footprint in the global economy has increased dramatically in the last decade. And as we shall see, it is not just what we all discuss, which is a footprint in terms of the size of its GDP in the world economy. It's not a footprint just in terms of trade, but also in terms of finance. Let me move on to other emerging markets. The emerging markets are in very rocky territory right now relative to where they were at the time of the global financial crisis. If you were to tell me the U.S. went into a deep crisis, Europe, much of Europe went into a deep crisis, how would that affect emerging markets? I would say, well, that's, if you look at the 1930s, there was a real risk that emerging markets would also fall into crises. And emerging markets did not fall into crises. Neither did Australia, New Zealand, Korea, Canada. It wasn't a global crisis. It was a subset of the large advanced economy crisis. But the reason the other countries did not fall into crises at the same time, whether they were advanced or emerging, was there was a sense of being lean and mean. In 2008, 2009, the emerging markets, the Turkeys, the Brazils, the South Africas, the large emerging markets had very little external debt, had very little domestic debt, and they were in a very competitive position with surpluses. This is not the emerging market situation now. So this is, I say this even though many of you may have less interest in the emerging market story. I say this because emerging markets in the early 1980s were about a third of world GDP. Now they're more than 60%. So when one talks about the global economy, it's an incomplete picture unless you talk about emerging markets. Now let me turn to, I have two more final topics on my agenda before opening the floor to questions. And one has to do, again, with China. I mentioned the influence of China as a large share of global footprint because of the size of the economy, because of trade, but its role in finance has increased dramatically. And a lot of the lending, I came literally the few days before I left for Asia, I was at the IMF lecturing. And one of the recurring concerns is the issue of the opaqueness of Chinese lending. In other words, if China makes a loan to Pakistan, if China makes a loan to Angola, if China makes a loan to Sri Lanka, this largely goes off radar screen. Let me explain. Credit rating agencies, Standard & Poor's, Moody's, all the credit rating agencies are focused on private creditors lending to sovereigns. So if it's an official creditor lending to sovereigns, it's off the radar screen. At the same time, the Paris Club is supposed to monitor official lending to sovereigns. But China is not a member of the Paris Club, even though the Paris Club has been insisting China join. And so this lending is largely off the radar screen. In a recent study that we are now completing with Sebastian Horn and Christoph Trebisch, what we document is that the official debt statistics that the World Bank puts together seriously underestimate the amount of external debt that many countries around the globe, as you see here from the region, have. In other words, World Bank data only captures about 50% of Chinese lending. So we have a problem of hidden debts. If the IMF is doing debt sustainability exercises, it's doing so blindfolded. If a private creditor wants to buy an Angolan bond, they do so without really knowing what the level of Angolan debt is and where their seniority may be. That is another risk because individually these countries are tiny. Collectively, the problem is much more significant. Finally, on this topic, not finally, but finally on this topic, to prove the point or to highlight the point that these hidden debts are a problem, I would note that there have been already more than a dozen debt restructurings of Chinese debts that have largely gone unnoticed by credit rating agencies and the like. My final point in the 2 minutes that I have, it has to do with perhaps an obscure point called the so-called Triffin dilemma. But let me explain. The Triffin dilemma arose because in the 1960s, the U.S. was the reserve currency, the U.S. dollar. But central banks and individual firms and individuals do not hold dollars. They hold U.S. treasuries. They hold debt. So there was the Triffin dilemma arises when a country that has a world reserve currency, there is a lot of demand from the rest of the world for that debt, which suggests they can issue a lot of debt. But the dilemma arises because issuing a lot of debt also makes the underlying country more unstable. So you have the domestic stability concerns with the global stability dimension of providing. And this situation arose in earnest just before the breakdown of Bretton Woods. Triffin predicted that, look, the U.S. government, then it was the Vietnam War, the U.S. government is issuing a lot of debt. They don't have the gold reserves to back that debt and to back that exchange rate. What was the outcome? The outcome was the collapse of Bretton Woods, and the dollar fell against the Deutschmark by about 55%. Okay, huge depreciation of the dollar. What I'm going to argue is that there are modern elements. This is my last slide. Modern elements of the Triffin dilemma. In work that I did with my former student, Ethan Ilsetsky, and with Ken Rogoff, my longtime co-author, we've shown, this was just published last month, we've shown that the demand for US dollars as the reserve currency is really at an all-time high. The euro has fallen by the wayside. The renminbi is still not convertible. It's still very limited at this conjuncture. But at the same time, the U.S. share of the global economy has been declining. So, yes, the U.S. dollar doesn't need to be backed by gold now, as it did in the 70s, but it has to be, debt has to be backed by goods and services to service that debt. And so what this suggests is that this is a long-run concern. All the evidence seems to suggest that there's this unwinding of the dollar yet to come. And I am saying this at a time in which every time the U.S. president comes up with another ad hoc policy, the dollar strengthens, because at the moment it is the reserve currency and there's a flight to quality. So let's be clear that I'm not talking about tomorrow or next week, because right now there are no alternatives. But that is sort of a longer term concern, if you will, that I wanted to share with you. And I'll stop there.
Okay. Thank you very much for a very enlightening speech. Professor Reinhart, could you sit down or okay, respond to some questions? May I have your questions? Professor Kim? Okay. Microphone. That's
Jeong-shi Kim from U.S. University. Right now, many Asian emerging market economies concerned on the sudden stop or capital flow reversal by the U.S.-China trade war. What do you think about the possibility of the sudden stop in Asian emerging market economy? And the second question is what do you think about the role of the Chinese yuan as a vehicle currency in the future? Thank you.
So those are two excellent questions. I actually have thought a lot about both of those questions. So the issue of sudden stops. First of all, let me define a sudden stop. This is my mentor, Guillermo Calvo, who coined the term, which is basically like capital inflows becoming capital outflows very suddenly. And I think the concerns are very real. And I mentioned when I said emerging market concerns, one thing that I think the vulnerability has increased to emerging markets is not just the concerns about the U.S.-China trade, but we've really forgotten in the 2000s what emerging market contagion looked like. If you go back, as I did, to the 80s and 90s, contagion was a very real thing. We saw it here in Asia in 97, 98 with Thailand starting, and then we saw it in the Russian crisis of 98. Hong Kong was affected, Brazil was affected for no other reason that they were liquid markets. So I think, meaning that that's where investors could get out of emerging markets. So I do think the vulnerabilities to capital flow reversals are very much in my mind. When I showed the China chart, and when I said a constraint to Chinese policy, monetary policy, is concerned about the fact that whenever the renminbi has been softening, it's been associated with outflows, is much broader than China. And of course, in the emerging markets cover a lot of ground. Within the emerging market class, I would say most Asian emerging markets are better poised than EMs elsewhere. Latin America is in very, very difficult shape, and not just Argentina. Brazil, Mexico, in South Africa, Turkey. So Asia within that class is still, the EMs in Asia are still better poised, but it's heightened risk. On the RMB question, everyone asks me, well, what is so special about the dollar? Well, and why not the euro? Why didn't the euro catch on more? And I think over the course of the years, I've understood that question better in terms of it's not about country size or even credibility. It's also about market liquidity. The U.S., you need for a viable reserve, global reserve currency, you need a currency. You need an instrument that markets can get into and out of relatively quickly and relatively costlessly. That means a deep liquid market. And right now, the market is the U.S. Treasury market, because in Eurozone, you don't have a Euro bond market. You have bonds, you have Italian debt, you have Irish debt, and so the lack of liquidity is a factor right now that is still, the RMB is starting to make its way into the traded world. It's weaving its way into indices. There's more of it traded in Hong Kong, but it's still very limited. And so it takes time, but it's going there.
Okay. Next, Professor Song. Yeah.
Hi, I'm Professor Tae-Yun Song also from the Yonsei University.
Connection with Harvard.
So you have mentioned a lot of issues on public debt. So especially in international financial system, you think that there are differences between the public debt and private debt? Because some countries have the high ratio, especially in private debt. Some countries, but in public debt. So do you think that what makes difference, or you think they are same? So
you're asking me a really tough question, right? Because in my work with Ken Rogoff, where we've gone back to the evolution, and there's specifically a line of work including a paper called From Financial Crash to Debt Crisis, which means a problem that starts as a banking crisis, private debt problem, how that morphs into a public debt problem. And the way it morphs, the way that private debt typically morphs into public debt is two main channels. One is sort of the one that people think about mostly, which is the bailouts, right? That, for example, if the concern is financial institutions that are highly leveraged, but that are systemic, those will be bailed out. Well, that initially private debt becomes public. But that doesn't end necessarily with just financial institutions. Remember, during the Asian crisis here, we had bailouts of shables that were not financial institutions. In the U.S., much of the addition to the debt has come also from the mortgage-related bailout, which sort of straddles the financial industry and households. So there is nothing written in law that all of the private debt is going to become public debt, but the recurring pattern is that high private indebtedness does increase the odds that those are in bad times. So a portion of that is a contingent liability. And from the vantage point of Korea, there's a huge night and day difference from 97 in that the debt is domestic. Okay? So that it's domestic household debt that is mostly, I think, on people's mind rather than external debt. External debt usually is the first thing where you see the transfers, where you see the bailouts. But it's still, even when it's domestic debt, in the U.S., the mortgage-backed area was domestic debt. It was household-related. It was ultimately, so that's why in my first chart, I said it's not just what you see, is what you don't see.
Okay. Mr. Oh?
I'm from Korea Times, and I asked this question on our way. I called you on our way to this conference room. But it's I wanted to put the layman's term on this the good lecture of yours. First one is what is the secret of success for the U.S. economy so far? You talked about the President Trump in the same breath as the Brexit. As it, obviously you meant the Trump is a kind of disaster, right? But you also talked about the ad hoc the comments by the President Trump that oftentimes the shock the financial markets and the markets as general. So my question is, and you also talked about struck the difference by saying that you don't expect the recession toward the end of the year. You expect the slowdown. So my question is, what's we need to hear what's what your assessment of the U.S. economy, and what's the secrets behind its success. That's it's comprised of full employment and the growth like the developing economy. Number two. It's about the trade war. You talked about it's. I think you put the economist perspective on the trade war between the China and United States, but it's more like the political war in a way. I think number one and number two, and one the old and existing power, and the emerging power is inevitable between the two the settle down. Who is who should be the first, right? It's like a comes with the DNA. So my question about that one is, do you think that if we do not have the trade war between the two, would the world economy in the better shape than now or in the future? Thank you.
So the question is, what is the secret of the U.S.? Well, first of all, let me say that for the definition of success, the bar for what is considered success has been coming down. I think the biggest success in the U.S. the biggest by far, is that unemployment has drifted to the lowest levels since the 60s in a low inflation environment. That, I think, however, I would also observe that that trend towards lower unemployment in a low inflation environment, in some degrees, is more general globally than just the U.S. I think without being any, negative tone to the president, I would say that that trend was underway when President Trump took office. The unemployment, if you look, all you have to do is do a plot of the unemployment rate and a plot of U.S. inflation, and those trends have been set in motion. In effect, Chairman Yellen, a recurring speech in her repertoire was saying, wanting to run. She was very dovish on the speed of normalization because her work on labor markets also had indicated that if you run labor market hot, participation rates will increase, and so what I'm saying is certainly the Trump tax cut was a big boost to confidence and so on, but the two biggest, I think, pluses for the U.S. economy, that low unemployment and high inflation, are long-time trends. That's on the trade war question. I hope that I made the point clear that I started out thinking that this was a trade war. I am not there now. My colleague, Graham Allison, who has written about the Thucydides, it's a Greek name I can't pronounce, trap, which is basically a new power challenging an old power, and that most of the recurring outcome has been war, I think has translated to a technological war, that meaning that the war is a Cold War about dominion in the technology space. So I don't, and that's an important point, because if I think this were just a standard trade dispute, one would say this closure would be closer at hand. But how do you close something in which your concerns about surveillance, you have concerns about security? The security apparatus in the Trump administration is now very involved in the negotiations with China in a way that it wasn't at the beginning. So that's my view, is that if that's your view, I concur that this is much more than a trade war, and therefore it has elements of a Cold War, and that these will linger. That I have some expectation that President Trump, prior to re-election campaign time, will want to show some markers of success, so that there'll be something. But I don't view that as the conclusion.
Okay. Time has already run out. Would you mind taking one last question?
I'm good.
Okay. Okay.
I've been a long time at the conference, so.
Okay. Okay, Shin? Mr. Shin?
Yes. Daniel Shin, I work with MCM, German luxury brand. If I remember correctly, you were born and raised in Cuba, right?
I was, yes.
And then now, because of all this trade tension, geopolitical tensions around the world, too many hiccups, but then also often miss out what's happening in Latin America, especially Venezuela situation, Guaido situation, seems to be quite depressing in many ways. So I just wonder, there was a power game, especially with some of the uplift of the oil situation and then political economies. Is that going to be as huge, like an influencer for the potential next big global crisis? That's one question. The other one is also your thesis advisor, Dr. Mundell, still alive?
About what?
Dr. Mundell, your doctoral advisor,
yes,
still alive?
yes. Uh-huh.
And then seems to be his all life career moving into Hong Kong, New York. Seems to be he is very in the middle of a hot seat where the biggest asset bubble you can expect. And then this bipolar situation bundled with the bubbles. Now a lot of low income people never really get a chance to buy their household throughout their lifetime, and then it's going to be another big influence over this potential crisis again.
So that covers a lot of ground. I am very, very concerned right now about Latin America, and again, Latin America is a very broad, very heterogeneous group. The situation in Venezuela, without dwelling on it very long, but let me highlight that you have to go to World War II Germany to find an output decline of 60% of GDP in such few years. And this is without being bombed. So that is a human tragedy. I have colleagues, Ricardo Hausman, who works towards trying to affect the transition in government, but I have no positive news to share on that score. But let me say that this relates to the question on emerging markets in general. Right now, I think some of the biggest weaknesses in emerging markets are, apart from the headline Turkey and Argentina, and Venezuela is in a league of its own. I think we could see the kind of contagion. This is a point that the kind of contagion that we saw in the 80s, that we saw in the 90s. If you look at one of my slides earlier, it makes precisely that point. And so, in terms of bubbles, I'm glad I had not brought up Hong Kong, but the closest comparison in terms of understand that Hong Kong is a financial center, so gross external debt, as defined by other countries that are not global financial centers, it takes on a different perspective. But the gross external debt of Hong Kong and the property values are reminiscent of Ireland and Iceland before 2007. So if one were to talk about risks to the outlook, that's certainly one that one has to. Finally, on the issue of inequality and I think the context has globalization increased inequality, and is it within borders or across borders? I did the blurb for a book by Maurice Obstfeld, Luis Catao and Maurice Obstfeld. Maurice Obstfeld was the IMF chief economist until a couple of months ago. Precisely looking at reviewing, and the contributors to that volume included Ann Krieger, Paul Krugman, Danny Roderick. And the takeaway was a mixed one. I mean, there is there was evidence that actually globalization sped convergence across countries, although by no means a blanket statement, and evidence that within countries it's associated with bigger inequality. And the whole tome of the volume was basically, well, how can we do policies better to address that?
Okay, this has to be the last question. Mr. Kim, could you make your question very concise, please? Yeah.
Thank you very much, Reinhart. You started out your talk saying that you are not a doom and gloom predictor, and you certainly were right in as far as this year is concerned. But looking at your menu, it's a very, very comprehensive risk factors. And let me add to that a couple of factors, if you may agree. Number one is taxation. Level of taxation now throughout the world, particularly the OECD countries, is very extensive. And therefore, when the crisis comes, ability for the government to tax and counter is something which is vanishing. And in fact, I am not sure whether there's any reserve. And number two is the second factor of countering that is not only, but this is particularly if you apply any country's risk factors, not only the timeline today, where the level is, but it's also how fast you are getting to there. And I would like to ask your opinion about it too. Thank you.
So, let me quote Rudy Dornbush on the second one. Rudy Dornbush had, is not speed that kills, it's a sudden stop. And Guillermo Calvo, who coined the term sudden stop, acknowledged the citation to Rudy Dornbush. The rapid buildup is much more vulnerable to a sudden stop because in this, perhaps I wasn't emphatic enough, but a point that I tried to make also when I was discussing the corporate debt problem was that rapid buildups are also associated with loosening standards, so that lower quality lending is taking place. And I do view that as a very real risk. Perhaps I didn't highlight enough, but when I was talking also about the quality reduction, you can only have so much of a boom. It's not like you're finding credit-worthy investments that much quicker. It's that you're lowering your bar. On the first point of taxation, I think that's an excellent point. And I would couch that as part of my point that fiscal space is limited. One area that I didn't talk about enough is in connection with your question on private debt become public debt. Part of the problem is that also if there's an onset of recession, tax revenues tend to collapse. Ken Rogoff and I were actually the work that Ken Rogoff and I, even before we published the book, did a short paper called The Aftermath of Crises, which explicitly looked at the behavior of tax revenues during downturns and basically highlighted that was a big source of debt accumulation. But related to your point, I want to make one additional point on limited fiscal space. The composition of expenditure in advanced economies is also problematic. We have advanced economies, Korea is no exception, an aging population where a larger chunk of the spending is no longer discretionary, and the contingent liabilities are not discretionary. So your ability to adjust down, your ability to do effective fiscal policy is much more limited as a share of non-discretion balloons.
Okay. Thank you very much for your brilliant speech and all those responses to questions from the floor. Once again, thank you for your presence here today. Appreciate.
Thank you for having me.
Thank you.